Singapore skyline highlights a trade-driven economy facing new headwinds. In 2025, a resurgent US-China tariff conflict, including a recent blanket 10% US tariff on imports from nearly every country, is rolling global trade. Singapore's small, open economy is feeling the impact. Officials warn of rough waters ahead and have signaled lower growth forecasts as trade slows. Analysts estimate tariffs could shave about 1 percentage point off GDP, with 2025 growth now seen around 2 to 3% down from 4.4% in 2024. Lower trade volumes and supply chain disruptions can cool Singapore's exports and manufacturing, and even ripple into finance and consumer spending. In April 2025, the US imposed a 10% tariff on imports from virtually all countries, catching even longtime allies off guard. Singapore's leaders say growth forecasts are under review. The economy could enter a new phase of lower growth, with knock-on effects on jobs and corporate profits. Stocks have been volatile. Broad trade war fears typically pressure cyclical sectors: trade, manufacturing, travel, and boost safe, income-oriented stocks. Singapore's markets may add band flow with US-China headlines, even if local policymakers try to cushion the blow. REIT's property Singapore REITs as REITs normally offer high yields and relatively stable cash flows from rents. Today, REIT dividend yields are near 8% on average, much higher than bond yields. By comparison, pre-tariff, pre-pandemic yields were generally lower, in the mid-single digits. These elevated yields reflect cautious valuations amid higher interest rates and uncertainty. Tariff-driven slowdown can affect REITs in two ways. Weaker economic growth may slow rent growth or occupancy, especially in office and retail REITs. But it also means investors seek income, which can support REIT prices. Notably, some REITs have defensive characteristics. For example, data center and healthcare REITs are in demand regardless of trade wars, while logistics, industrial REITs benefit from e-commerce and global supply chains. Even if trade slows, local warehousing demand can hold up. Yield trend. Mid-2024 data shows average S-REIT yields around 8.1%. By contrast, yields were closer to 5 to 6% before the major tariff escalations of 2018-2019. Higher yields now partly reflect buyers requiring extra income amid global uncertainty. Sector impact. Higher vacancy risk for office, retail as multinational companies pull back. Industrial and logistics REITs may be more resilient. Goods still me. Warehousing. Tourism-linked REITs, hotels, malls can suffer if global travel slows. Lower financing costs if policy eases could help REITs borrow cheaply, but overall demand is key. Key risks. Rising interest rates, though easing is expected. Global slowdown reducing tenant demand, and property values slipping if businesses downsize. On the flip side, Singapore's strong rule of law and stable rental markets give REITs a hedge versus emerging markets. REIT picks. Consider high-yield S-REITs with solid business models and Singapore focus.
For example, Mapletree Logistics Trust SGX, M4U, an industrial warehouse REIT, offers around a 7.6% yield, backed by multinational logistics tenants. Another is Keppel DC REIT SGX, AJBU, a data center REIT yielding about 6.6%, benefiting from ever-growing demand for data services. These trusts tap essential sectors: e-commerce, logistics, and digital infrastructure, and have diversified regional tenants, which can make their dividends relatively stable even in rough trade conditions.
Thanks the three Singapore banks DBS, OCBC, UOB are among the highest-yielding blue chips here. Bank dividends depend on earnings, loan interest, fees, which can be hurt by slow economic growth. However, Singapore's banks are well capitalized and have weathered crises before. Tariffs affecting US and China trade can indirectly slow export-related lending and reduce transaction fees. Also, if the central bank loosens policy to support growth, net interest margins could be squeezed. Dividend yields. Local banks have robust yields today. For instance, DBS's dividend yield was about 5.5% in 2024, up from roughly 3% back in 2019. OCBC and UOB trade at similar yields, around 5% plus. These yields look attractive compared to regional peers, reflecting steady payouts and modest loan growth. Sector impact. A trade-driven slowdown could temper corporate lending, especially in trade, finance and export industries and lower investor confidence. But low domestic unemployment can strong household balance sheets or positives. Interest rate cuts could reduce banks' interest income. Banks may also set aside more reserves if loan defaults tick up. On the plus side, higher volatility might raise demand for hedging and wealth management services, giving banks fee income. Key risks: slowing lending growth, higher credit costs if companies struggle, and currency swings. Trade wars can make SGD rise as a safe haven, which can dent export competitiveness. Still, Singapore banks large capital buffers and diversified businesses wealth and GMT. Insurance, regional banking provide resilience. Bank picks: DBS Group SGX, DL5. Singapore's largest bank, with a strong balance sheet and about 5.5% dividend yield recently. Its franchise is diversified consumer, corporate markets, which helps spread risk. OCBC Bank SGX, 039. Yields in the mid-5% range similar to DBS. OCBC has a big presence in Greater China and Southeast Asia, which can be a double-edged sword during a US-China slowdown but also offers growth potential and trade stabilizers. UOB SGX, U11 also yields approximately 4%, but DBS, OCBC tend to be the largest dividend pairs.
Telecom firms, mobile, data providers, and infrastructure trusts are classic defensive dividend plays. Their revenues are relatively stable. People still need phone and internet service even in downturns. Tariffs don't hit telcos directly, though a weaker economy might slow business investment in telecom equipment. Competition and technology shifts like 5G rollout costs are bigger factors for them. Dividend yields. Telcos typically yield mid-single digits. As of 2025, Singtel SGX, C7 for offered around 5.2%, and StarHub SGX, CC3 about 6.2%. These reflect recent dividends relative to their stock prices. Singapore's third telco, M1, yields around 4 to 5%, but it's smaller. Sector impact. These companies have mostly local, regional markets. A trade war's indirect effect on telcos might be minimal. However, if consumer, business spending tightens, it could cap subscriber or upgrade growth. Conversely, telecom usage often holds up, so earnings are usually reliable. Regulator policies such as license renewals or new service rules are as important as global factors. Key risks: market saturation, few new customers left, intense competition, and tech changes, for example fiber versus mobile. Potential opportunities include 5G and fiber infrastructure investments. Telecom picks: StarHub SGX, CC3, historically a high pair, with approximately 6.2% yield. StarHub has a stable Singapore subscriber base and offers cable TV, internet, which diversify revenue. Singtel SGX, Z74, the largest telco, approximately 5.2% yield, with regional operations, for example Bharti Airtel in India. It has more moving parts, but benefits from scale. Netlink NBN Trust SGX, NETL. This fiber infrastructure trust, formerly NBN Co, yields about 5.8%. It's a pure-play broadband network operator with regulated returns, providing steady dividends. Including such infrastructure plays add stability to a telecom slot. Energy and utilities. Singapore's energy and utility companies include power grid operators, gas distributors, and energy engineers. These firms often have regulated or predictable cash flows. In 2025, energy stocks yields are moderate, mostly 3 to 6%. For example, Sembcorp Industries Power and Water Solutions plus Offshore Engineering pays about 3.7% yield. SP Group Power Grid Operator and City Gas Utility each yield roughly mid-single digits. Sector impact. Tariffs can influence energy prices globally. A global slowdown tends to lower oil prices, which can reduce costs for electricity generators, but also hurt energy exporters. Not Singapore's case. Singapore is a net oil importer, so cheaper energy can slightly lower inflation. Domestically, utility demand is fairly inelastic. Even in slowdowns, factories and homes still use power and water. That said, any big downturn might lead to slightly lower industrial energy consumption. Key risks: commodity price swings for energy-related businesses, regulatory changes, energy policy is strategic in Singapore, and capital intensity. These firms invest heavily in infrastructure, The upside is steady dividends due to regulated business models, for example fixed returns on grid assets, energy picks. Sembcorp Industries SGX, U96, diversified into power generation, water, and previously offshore. Its dividend yield is about 3.7%. Management has been pivoting to renewables, which may benefit long-term. SP Group SGX, S58, Singapore's electricity and gas grid operator, massive utility provider. Its yield is around 4 to 5%, noted for stable dividends, though it's essentially a locally encouraged monopoly. It's a defensive, bond-like play if you want exposure to energy infrastructure. City Gas and Keppel Corp are other names in this area. City Gas yields approximately 4 to 6% historically for piped gas utilities. Practical strategies for Singapore investors. With the landscape above, here are some practical approaches tailored to Singapore dividend investors facing tariff volatility. Dollar cost averaging DCA. Invest a fixed amount regularly, for example monthly instead of lump sum. This removes pressure to time the market. You keep buying whether prices are up or down. Over time, DCA smooths out your average purchase price and builds shares consistently. For example, every month buy $1,000 of a dividend, ETF, or blue chip stock. When prices dip, you automatically buy more shares. This strategy can lead to a lower average cost and reduces the stress of guessing market tops or bottoms. Sector rotation. Be flexible in your allocation. Utilities, consumer staples, or healthcare REITs that hold up better in slowdowns. When news cools off or signs of recovery emerge, you can rotate back into cyclical sectors, industrial REITs, banks, travel-related stocks to capture growth. In practice, this means rebalancing every few months, e.g., add more telco, utility shares when markets dip, then trim or shift gains into growth names later. Diversification and cash buffer. Don't put all your funds into one stock or one sector. Spread investments across the 4 sectors above and even beyond, like including an Asian dividend, ETF, or some global equity exposure. Keep a cash reserve 3 to 6 months of living expenses on hand. A cash buffer lets you weather short-term drawdowns without panic selling, and gives you dry powder to buy at lower prices if markets tumble. As Investopedia advises, diversification means holding a mix of various investments so you're not wiped out by any single shock. Whenever you receive dividend payouts, reinvest them, buy more shares, instead of pocketing cash to harness compounding. Each dividend purchase buys additional shares, which then generate more dividends, creating a cycle of exponential growth. Over years, this can significantly boost your returns. In Singapore, dividends from local companies are tax-exempt for residents, making reinvestment especially efficient. You can automate this in a brokerage by using a dividend reinvestment plan DRIP if available, or manually allocate each payout. The key is long-term discipline. Even small dividends add up as you acquire more shares over time. By combining these strategies, DC8 to avoid timing risk, prudent rotation between defensive and cyclical sectors, maintaining diversification and liquidity, and plowing dividends back into stocks, Singapore investors can better navigate the uncertainties of the US-China tariff conflict. Over the long run, focusing on solid high-dividend local stocks and steadily compounding those dividends will help grow your wealth even in choppy markets.